Well, hello, everybody. Welcome back to Finspire's Focus on the Markets, AI, Artificial Intelligence Edition, second quarter 2024. We couldn't think of a better theme than to have me start in the belly of a chatbot on this slide here to get you through the next few slides as we talk a little bit about how artificial intelligence has changed markets, how it's impacting the economy, and what we expect moving forward. So along the way, as you can see here, there's a little bit of a robot type character that my picture's in currently. And so I asked our team internally to generate a chatbot of their own for Finspire. So you're going to get to see some of our fun that we've had with artificial intelligence, especially with creating images throughout this presentation. And hope you have fun enjoying and listening to our commentary along the way. All right, let's get into it. Hey, we're going to get into our opinions, of course, but we're always going to start with things that are fact-based and draw some conclusions about what's going to occur, what might transpire in the future. So let's get into it. Let's get into our capital markets strategy board. All right. So what do we do, right? What are we doing from an investment perspective, given this AI-fueled arrangement, both in the economy and in the markets that we're seeing today? First and foremost, the economy grew in the fourth quarter at 3.4%. Very, very strong number. Caught a lot of people off guard as to the breadth and strength of how the economy has been growing. And estimates for the first quarter of this year are closing in on 3% growth for first quarter GDP. It could be a little bit lower than that, but the Atlanta Fed just bumped up their estimate to 2.9% for the first quarter. That's another very strong quarter. And you're going to see why as we move through this. So what do you do on a portfolio basis? Well, as a result of a stronger than expected economy and slightly hotter inflation that was desired, we're getting higher interest rates again. So what do you do in that scenario? Yes, equities can move higher or lower in that type of environment. Certainly very significantly higher in the first quarter, significantly lower so far in the second quarter, in the month of April thus far. But what do? You can take advantage of those higher interest rates. Higher interest rates means higher bond yields. Higher bond yields means that you can even for a investment grade bond index capture 5-6% or more, capturing different pockets of the fixed income environment. Yes, equities could remain strong. Growth equities could do very well in a strongly growing environment, but over time, as growth equities, despite the fact they have strong earnings supporting their prices, they can get pricey. And it's important not to overlook some of those other sectors in the markets that have other sectors of the economy that have great potential, but maybe the markets haven't fully appreciated their worth or their value quite yet. So we're starting to see, hopefully we started to see some broadening out of that base of support in the equity markets. And we think we're going to see that happen again in the second half of this year, especially when we get into the summer months beginning in June. Okay, I mentioned the equity markets have been strong. Equity markets bullish trend is continuing. But as you'll see, as we've experienced, especially in the month of April, that pullbacks are normal and they do occur regularly inside bull market trends. And we may be in that currently, right? The benefits that we're seeing of this is that stocks and bonds tend to are supposed to have a lower correlation with one another, sometimes negative during a very normal market periods. And for the last couple of years, we've been more in a correlated scenario where as interest rates and bond values went up, or as interest rates and inflation climbed, markets declined. And then we saw the inverse of that, where interest rates started coming down and bond and equity markets rose. We typically want to see an environment where, hey, if bond yields are rising, equity prices should rise too, which should indicate under normal circumstances a stronger than anticipated economy, which is helpful, of course, to both equity prices and drives bond yields higher because you got to pay more in yields in order to be more attractive or to compete with investors' dollars when it comes to deciding whether they should invest in stocks or bonds. But lost in that, I don't want to lose in that translation also the potential appeal of overseas equities. Overseas equity indices do not have as great of a reliance on technology stocks as we do here in the United States. And overseas markets fared pretty well in the first quarter, up almost 6% in developed markets. Don't forget those in a diversified portfolio because they can be very helpful, at least providing some global diversification and at least providing diversification away from the tech sector, which the U.S. is highly dependent upon for a rising tide. So keep an eye on that. We'll look more into that in a moment. Politics. This is a crazy political year already, and it's only April. Yes, the general election, Trump, Biden, Kennedy, is going to be a long, drawn-out process between now and November. I mentioned in the last quarterly video, that the race for Congress is very interesting to us, primarily due to taxes. Sunsetting in current tax rates sunsetting and after the year 2025. Well, little did we know that this battle for Congress would surface even sooner, because right now, due to retirements and resignations, the Republican majority in the House of Representatives has shrunk to approximately one vote. Depends on the day. And what that does, that has given Democrats in the House a lot more power and say as to what occurs. And we're seeing some interesting things transpire even as we speak on this video currently, that it does appear that the House majority seems up for grabs even before the election is going to occur in November. So when you have all this unrest, which triggers unrest overseas, think Ukraine funding, Israel funding for wars overseas, and you have monetary concerns from central banks on how they're going to get out of this inflation pickle, you have a ripe recipe for even adding things like gold to the portfolio, which we'll talk about. I know we've talked about that in the past, but I'll show you some things later on in the presentation that has a direct relationship between how much gold you should have versus how fragile the political and geopolitical environment remains, and that's certainly a hot topic. Okay, so I mentioned that I had our team have some fun with AI in trying to create a Finspire chatbot. So on a couple of these slides, you'll see an image of what one of our teammates came up with as a potential Finspire chatbot. Now, we've all had experiences with chatbots by now, whether it's for booking airline tickets or trying to get something done with an invoice or something like that, where you've had to go and you had questions with some type of software that you used. And so we used AI just to have some fun and generate a couple images along the way throughout the rest of this presentation. So let's get back on track with the stock market all-time highs. 22 all-time highs in the S&P in the first quarter. That's incredible, especially after the last couple years where we had only one, which came on the very first business day of 2022, and then we headed down significantly after that. And you can see that hitting new all-time highs often is a precursor to hitting new all-time highs until it doesn't, like we had in 2022. So when you see, is the market too expensive? Did it run too hot? Did it go too high too soon? Not usually the case. Usually is the case where you have all-time highs begets all-time highs. All right, so Heather Williams on our team came up with this Finspire wizard here, who is waving the wand and saying, "Give me new all-time highs," and that was pretty powerful by this wizard chatbot, indicating the new highs in the S&P in the first quarter. As I mentioned, we've since retreated in the month of April, but we'll talk about that again in a moment. Strong asset class performance across the board. Yes, the bulls won this tug of war here. James Jaramillo came up with this bull and bear generated image here, fighting for the money, with really the bears being the fixed income investors and the bulls being U.S. equity investors. And that's largely been driven by artificial intelligence. If it sounds familiar, it's because it does. When we looked at this a year ago, very similar occurrence in the first quarter and second quarter of the year last year in 2023. It was an AI-generated bull market run in the equities. At the end of the year, other asset classes played catch-up, and it did happen. They played catch-up, especially strongly in the fourth quarter. This year looks a lot similar to 2023, where we had a really strong out of the gate in the first quarter. We've since pulled back in the month of April, only to what we feel will be a healthier equity market and with broader representation when we catch the third and fourth quarter. That being said, I did mention that international equities plus 6% to start, almost 6% to start the first quarter, start the year in the first quarter. Remember, very little. There's about a 3-to-1 ratio of allocation towards technology stocks in the U.S. and the U.S. indices relative to overseas equity. So there's a far less reliance on technology stocks overseas, and so that gives you some indication that there is some broadening out of this bull market can occur, especially after a healthy pullback that we may be in currently. That being said, in a balanced portfolio, 5% in the first quarter is fantastic, and that should bode well for future quarters when we look into the summer months and beyond. Okay, squirrels are a big hit with our office. I can go into a whole nother video as to why, but here's Chuck actually had an AI generated image here of a squirrel, just squirreling away some of his gains. And that's really what has happened in the first quarter with these Magnificent Seven stocks, or really since post first quarter in the month of April. Meta, Amazon, Apple, Alphabet, Nvidia, Microsoft, Tesla are sometimes referred to in the financial press as the Magnificent Seven. Some of us know the Magnificent Seven as a great Western movie from decades ago, but you can see the impact that the performance of those 7 stocks has had relative to the rest of the markets. It's been unbelievable. So if you look at the Magnificent Seven since January 2020, 317% gain versus the S&P of 63%, and the NASDAQ, which is a tech-heavy stock exchange, at 83%. Those 63 and 80% numbers are fantastic as they are, but you can see the 7 stocks that have really driven the market higher. It's not going to be like that forever. So you're going to see times where it's time to broaden out, which we could be in for, especially when we get through the second half of the year. All right, crazy like a fox. This is Jason Brooks' AI image of a chatbot of a Finspire fox. I thought this one was pretty clever. Good job, Jason. And you can see here what really fooled us, and fooled not just us, but fooled economic prognosticators, is that, look, historically over the last 50-some years, leading economic indicators start going south like they have right here in 2021, 2022 and 2023. And usually you would think, based on history, that recessions would follow. Recessions are in the gray bars here as we look across the chart from starting in 1970. And it never materialized. Why is that? Even though we're seeing some strengthening here of the leading economic indicators as of late, this has been a pretty big gulf relative to other dips in the LEI, or the leading economic indicators. And there's a reason for it. It really has to do with the economic activity. What's doing well and what's not doing well. Typically, manufacturing and services moves eventually in sync with one another. And in this case, over the last year plus, we've seen the services sector continue to expand. And we saw this post-COVID with a big focus on consumer spending on experiences post-COVID. That momentum has continued. And although manufacturing remains in contraction mode, so anything above this dotted line is expansionary, anything below this dotted line is contractionary. You look at over 20 or 25 years of history, you can see manufacturing has been in contraction. It hasn't been in deep contraction like we saw, say, in 2020 or even 2008, 2009, but it's being offset. Those contractionary measures have been offset by the continued expansion of the services sector, and that's really occurring because people remain employed. Now, I asked artificial intelligence here to say, generate for me an image of 2 people going to a job at the same time. And this is what it gave me. And although there's some data that back this up, that you see a lot of people working second jobs to keep pace with the last couple years worth of inflation, it is a very, very strong demand for labor out there, despite the fact that artificial intelligence is likely to be a significant contributor to the number of job openings in decline. Now, we've noted this in our videos in the past, that the number of job openings well exceeded the number of people looking for work. We just didn't have the available workers to fill all the job openings. Well, some of those openings have declined. Why? We see that in a lot of the data, the labor data that's posted monthly, not just in the labor report, but we see in the productivity numbers as well. Those are all really important figures to looking at what the future would hold for an AI-fueled labor force. And what we see and what the data shows is that people are doing more with the same number of hours worked, greater output with the same number of hours worked. And that's largely driven, likely, being fueled by artificial intelligence. So it's having a big impact on our economy via the labor force. This also could be a good thing for inflation long term. But when we saw in the 90s, when the technology boom and the wave of the internet came about, we saw actually inflation remain a little bit higher than the Federal Reserve's preferences because the labor force became significantly more productive. And we've seen that 2 quarters now in a row where productivity has been well above historical averages. We get some fresh numbers on that next week when we look at productivity in particular, and to see how more productive workers are in this AI fueled environment. Okay, Sue Gersh. Sue Gersh was employee number 1 along with on our team back in 2018, and she does a great job with as a VP of Finance and HR, and so she oversees our books. So it wouldn't surprise me that her Finspire chatbot is a piggy bank. I like the bespectacled piggy bank as well, Sue. That's a good touch. And I thought the earnings chart would be a good one for this because we get the question a lot: is this just like the tech boom? I just talked about the internet boom from the 90s. Is this the same? Not really. Because look, when you see that the S&P 500, which is this jagged line, exceed or eclipse the mountain chart of earnings, of actual earnings, that's when you reach potential bubble territory. And you can see, even despite this big run up here in the S&P 500 the last couple of years, and this big rebound, you can see earnings just at the tail end here moving higher. So earnings, this is the difference between artificial intelligence and the internet boom of the 90s, is that you have a lot of cash generating businesses, especially think semiconductor chips, right? The NVIDIAs of the world and others who are making chips at a rapid pace, and they're doing it through new purchase orders, right? And as a result, earnings have been quite good. Across, not just in the tech sector, but also across the board. And you see growth in earnings, more importantly, and that ultimately is good for the long-term health of the stock market. All right. So I asked AI to generate an image for me of attractive valuations. And this is what it gave me. And it gave this some sort of scale or balance here of people staring at lots of money, I guess, or coins inside of on a scale. Well, it's not just that the large cap U.S. equities have performed well in the first quarter and it's driven up the valuations or the price that you pay for the earnings generated, but it's also true that there are opportunities elsewhere. Now, there are opportunities elsewhere, but you can't always just look at the raw headline numbers to determine where you're going to allocate money or where you're going to allocate your next dollar. So, for example, yes, U.S. small companies represent a better valuation opportunity than U.S. large. Same with overseas equities we've talked about. However, it's not always as straightforward. For example, small companies are more impacted by higher interest rates because their cost of capital it becomes much higher and more difficult to make that hurdle rate more attractive to investors. If interest rates start to come down a little bit, we think small caps are going to be a little bit like a coiled spring. Like they're going to jump off the mat, just like they did last year when interest rates started to fall. And that's why we see some similarities between this year and last year. Again, very interest rate oriented, interest rate sensitive, I should say, with small companies. One thing you want to be cautious of is looking at a column like this. Now, what we've seen this chart in the past, the bar represents earnings growth and the diamond represents the valuation. So in an ideal world, you want something with a high earnings growth and a low valuation. That would push capital that direction, because eventually that's got to correct itself, right? You have to have prices go up to reflect the earnings growth that's estimated to occur over the next 12 months. Now, emerging markets is a little different. Why? Because China actually represents 40% or close to 40% of the emerging markets index. And so we have to always take Chinese equity, China's economic growth, and also Chinese equities as a result. We have to be a little bit more careful in terms of risks as it relates to that. So It's not always how it appears in just the numbers, as we know. That's why we always want to look beyond that. Okay, let's take a look at inflation. I mentioned there's been some recent pushback up in inflation, and inflation is hitting pocketbooks in a cumulative manner, right? This is how pernicious, I should say, inflation is that it's cumulative. And so when you see things like inflation, consumer price index, for example, push back up in the last couple months, it gives you a little bit of concern about are we heading back for higher energy prices? Is that going to spill over into higher cost of goods? Look, we're going to get more inflation data. Directionally, we're still on a long-term trend lower in inflation growth, but that's what it is. It's inflation growth. It's not deflation, meaning that prices continue to climb. And that can be actually eventually disruptive to equities as interest rates either stay where they are or, in the worst case scenario, perhaps even raise higher. We don't think that's going to happen. We don't think the Fed's going to push higher again, but we do think perhaps all these rate cuts might be pushed out a bit. But that being said, we're still on a directionally trend lower, and we do want to see these numbers continue to fall so that interest rates come down, and it'll handle a lot of those other assets. It'll improve the performance of a lot of those asset classes. All right, James Jaramillo here came up with this AI image of a penguin family looking after their coins. That's interesting, James. But nevertheless, I thought it was pretty creative. Consumer sentiment's a big part of driving not just economic results in the future, but also can add fuel to a bullish equity market. Typically, when you see sentiment rising, you see people who are employed, and hopefully their wages are exceeding that of inflation. And we're starting to get a combination of that now. It took a long time, but we're starting to get a combination of that now. And perhaps if AI is making them more productive at the office, perhaps that's help fueling consumer sentiment to be driven higher. But you can see we're still well below historical average sentiment. And we're not quite where we were pre-COVID, which is up here. And so we want to see these numbers continue to climb. That would actually be a really good recipe for fueling the bull market. Why? Because a lot of consumers, a lot of investors have a lot of money in the trillions sitting in money market accounts and cash. And if that starts fueling the bull market higher, you could see when the market does turn back to a positive territory after this pullback, that we could see a pretty significant jump in the equity markets, especially given that consumer sentiment is where it is. Now, consumer sentiment is not always as favorable when they look at Congress. Okay, we know Congress historical approval ratings are usually terrible, and right now is no different. So here I had AI generate an image of a donkey and an elephant looking over their shoulder at the zoo. And for those of you who don't know, a donkey is the symbol for the Democrat Party. Elephant is a symbol for the Republican Party. They're both sort of laughing at everybody else at the zoo. Why is that? Because they continue to spend. They've run up trillions and trillions of deficits, and also the national debt's growing substantially. You can see it's amazing. As a percentage of GDP, debt has grown sharply as a percentage of GDP from just shy of 40% as little as 15 years ago to basically a 1-to-1 ratio of debt to actual GDP production. This typically is not healthy. It's also not healthy when we run massive deficits during economic expansions. That's why there's so much inflation. One of the big reasons why there's so much inflation. And so this is an area that is concerning. It actually creates some pressure on interest rates. So I had AI generated image here on the right of a yield curve causing danger. And this is what it gave me. It almost like some sort of roller coaster-ish, like you're riding a roller coaster in the middle of a huge thunderstorm or dark clouds. Anyway, it does contribute to higher rates, right? It does contribute to higher yields, puts pressure because if for some reason we're not as able, government's not as able to pay back their treasury bonds or treasury interest back to investors and pay back those bonds over a period of time, whether it's 10 years, 20 years, 30 years, et cetera, that there's a lot of pressure on yields to move higher. So that makes more attractive to investors to purchase that government debt. I don't know if it's that dire today. I don't think it is. But however, that is having an impact on higher yields, as well as a stronger than expected economy and higher than expected inflation. So those are all contributing to higher yields and putting pressure on fixed income returns. But we would like to see that pressure relieved, a lot like what occurred last year when that pressure was relieved in the fourth quarter on yields, which drove not just equities higher, but also bond values. Bond prices went up as well as they became more and more attractive. Okay, what it really does is but also makes things like gold more attractive. So as central banks around the world wrestle with government spending, deficits, debt, they're oftentimes at the same time purchasing more gold to back up their currency. And that has driven the supply-demand curves with gold higher, driven gold prices higher because that demand for gold is really at a peak right now, and or at a historical peak, I should say, as gold prices have eclipsed all-time values, all-time highs. And again, in this environment where if you have countries trying to devalue or debase their currency, then you oftentimes get an appetite for gold, and that's what's happening right now. And so we expect this to be a multi-year trend of gold prices going higher, and can be a part of a diversified portfolio. And I had to do it. This AI image of a leprechaun finding the pot of gold. It was too easy. That one was too easy. So right now, gold is an attractive asset class in a diversified portfolio. Hey, I just wanted to say thank you. So we did it in an AI-generated fashion. First, this picture. This isn't actually me, as you can tell, but nevertheless, neither are these people part of our teammates. But I asked AI to generate an image of a financial professional saying thank you. So thank you to you. And so you can see AI can have some tremendous benefits at not just generating images, but also improving productivity. And sometimes it creates some things that are a little bit off, as we've learned, and as Google learned the hard way a couple months ago. But I'd also like to take the opportunity for an AI-generated welcome to our newest member of our team, Nate Freeman. Nate's joining us this week, and Nate has joined us this week, and we're excited to have him as a Senior Vice President of Business Development. And so we're looking forward to Nate meeting you and talking to you in the future at future meetings. That is not actually a picture of Nate in the AI-generated image, but it is actually an image of a ticker tape parade welcoming Nate. Welcoming a guy named Nate Freeman. So interesting how AI can boost productivity in our lives, can also create some very interesting images for us. Along the way, we can have a little fun with this new invention. Thank you very much. We look forward to talking to you again soon and seeing you at a future meeting.